Back with Midcap Masala, and one of the big events that we saw last week, Shrishti, was the RBI policy. And the key takeaway from that, in the governor's speech towards the end, he mentioned how they are going to be proposing the inclusion of quarterly profits in the computation of CRAR. So to try and understand the impact of this and what this would mean in real life if this were to happen. And of course, to talk about a lot of other business updates as well, let's welcome on board Mr. R. Baskar Babu, the MD and CEO of Surya Small Finance Bank. Mr. Baskar, morning, and thanks so much for your time. Now with this RBI proposing inclusion of quarterly profits in CRAR, how much capital headroom does this unlock for growth for your bank going ahead? And also give us a picture on CASA. It improved to 22.5%, but still trails your larger peers. What is the aspiration there? How is this provision, if passed, going to aid that?
It will certainly help in terms of including the quarterly profits in terms of calculating capital adequacy. Instead of waiting for not only the year end, we'll have to wait till the audited financials come out and only then you can add it. Earlier we were excluded, now we have been included, and also the clause of provisioning should not be varying beyond 25% has been eased. That's, I think, is a very good one, because in an increasing scenario also the provisioning will come down. Will there be a change beyond 25%, it is for good. So this will really help us in terms of adding quarterly basis, marginal but very positive. And as far as our CASA is concerned, we're really focusing back in terms of what is truly a granular, sticky deposits to be in savings account or current accounts. It should not necessarily be the bulk money sitting on it at a high cost. A flow should lead to float, which is the classic CASA. So we have started focusing on it. Glad that it is inching up by 150 basis points year on year. The intent is to, can we have the CASA, which is truly low cost, sticky, happening out of the flow happening in the transaction, in the account.
All right, good to know about it. Morning, Mr. Baskar. This is Shrishti also joining in. But what is the normalized credit cost for FY27? And what are the key assumptions there in terms of slippages, recoveries, write-offs that you might need to achieve this?
27 looks good in terms of both growth as well as in terms of credit cost substantially will come down. But however, it all hinges now on the situation which is going on. So hopefully, if things don't really worsen and they stabilize, likely that the credit costs overall for at least the SMB sector, which are predominantly at least have 40 to 50% microfinance, will be kind of easing out by 25 to 50% compared to last year. Last year was a very challenging year. As we enter FY27, it looks both good or both on in terms of the credit cost mitigation as well as in terms of our growth itself looking pretty strong across the sector. Specifically for us, we are targeting around 25 to 35% growth in terms of assets, in terms of deposits, and hopefully on the profitability as well.
That sounds really optimistic, 25 to 30% growth you're targeting across key metrics. But I have been looking at some other numbers too, Mr. Baskar. Your cost to income ratio is still around 75%. If you could help us understand what are some levers at play right now, or some plan of action that you're deploying to try and bring this below 65%, when can we realistically expect this?
This includes the insurance costs which pay on the credit guarantee fund. We chose in the good time at FY23 that since this is cyclical at once in 4 years, once in 5 years, or rather we truly consider as an insurance that if you don't make a claim, the portfolio quality is very good. But in case of one swing in kind of years which is unpredictable, we want to protect. That kind of contributes to around 8 to 10% of our overall cost. Minus that, we are still currently reasonably good at 65. The intent is to calculate the cost to income minus the credit guarantee fee which we pay on a year-on-year basis. Currently, most of 98% of our 50% portfolio, which is in inclusive finance, is covered by CGFMU. And that comes to around approximately 1% of the portfolio, 1.5% in terms of credit cost. If we calculate that in the OPEX, minus that, we are currently at around 60%.
All right, but along with that, Mr. Baskar, despite strong loan growth, your profitability seemed to be lacking. What are the key drivers that are required to move your ROA from 0.9% to the guided 1.2 to 1.5% range?
Mainly credit costs. So last year we had to provide for quite a bit in terms of credit costs because of the mini crisis in the microfinance segment, which has not eased out. And more importantly than that, we kind of wanted to protect ourselves, ring fence in terms of cyclicality. We moved into not only individual loans to the inclusive finance customer. We kind of now started doing appraisal in terms of individuals. It is a little expensive, not time consuming, that now it's happening through digital mode. So hopefully because with this would really contribute more than PPOP has been steady. But beyond PPOP, the credit cost is what really dented our return on assets and hence consequently the return on equity, both of which should improve as we see last quarter and hopefully as we guided in this quarter. The previous quarter went by and FY27 looks far more robust in terms of substantially reduced credit costs.
Okay, so that looks good. And on the back of that, Mr. Baskar, your NIM guidance of 7.5 to 8%, are you maintaining that? Are we looking at any revision over there?
That is intact. Couple of
Okay.
around say 6% of our book is non-earning. So that will kind of ease out once we make our claim under CGFMU and provide for it and write off as required. Suppose that even today minus that it's comfortable at around 8.5%. We intend to maintain it. It's not going to be substantially higher, but it will be consistent and moving up by 25-50 basis points for at least the next couple of years.
Okay, and Mr. Baskar, in your commentary for next year, you've also said digital businesses like credit on UPI, digital deposits, they're expected to scale and support growth. What part of the business mix is this going to be? And also credit on UPI as a section is also scaling rapidly. What are the early delinquency trends that you're seeing here compared to the traditional MFI playbook?
Currently, the credit on UPI, which CLOU, what we do is that it's almost like a charge card. The entire money had to be paid on the due date. So whatever is the fee income that we make out of it, minus the payment which is not coming even for 3 months, it's still on the positive range. It's a beautiful, good engine in terms of acquiring large number of customers. As we keep saying, it's going to be really democratizing credit. We can acquire customers who are giving a credit as low as even 100 rupees. Currently, our average is around 5,000. We have 1 million customers who are approved, and around half of them have taken the sanction, and around 3 lakh customers have utilized it. So it's kind of doubling on a smaller base month on month, watching it. And since these are people who have earlier utilized and have good track record, have proved in the last 1.5 years and a good credit score, we do really expect on the month on month basis, it's likely to be around closer to 2 to 2.5% max. As of now, we are seeing much lesser, but that's a playbook is in terms of looking at maybe 2% of the overall disbursements on a monthly basis may go as a bad debt, but the 98% who pay will continue to be profitable because they're utilizing it on month. On the digital deposits, we have seemed to have done a good job. Currently, around 40% of our incremental fixed term deposits are coming through digital mode, which is average of around 1.5 lakhs, completely granular. So that's what really excites us. We would like continue to do that and focus on this digital deposits. We are currently at around to just cross 2,000 crores in terms of completely granular 1.5 lakh depositors, approximately around 1.25 lakhs of deposit per customer. Likely that this will double in this current year of FY27.
That sounds good. Mr. Baskar, talk to us about asset quality. The number that we saw, at least towards the end of Q3, is slightly away from the guidance that you had given for overall FY26. If I'm not wrong, you've guided for roughly 3% NNPA. That number has come at roughly 4.3%, at least till Q3 end. If you could just help us understand what is the roadmap to reaching this 3% number on your net NPA?
The slippages had been high in the first quarter. So, however, ours, as I said, is completely covered under CGFMU, likely to make a claim and we'll get it in Q1. And once we kind of get it, it set off against the cross NPA. Till we make a claim, it continues to be in our book and hence looks elevated. Post that, it's likely to be substantially lower and closer to the guidance which we've given.
Okay, and lastly, Mr. Baskar, before we let you go, I'm just trying to understand, the ROA that you had guided for last year, that was then moderated slightly lower. It was revised to 1.2%, and as of now, it stands slightly lower than that. Any visibility on how far 1.2% is from here?
We are kind of now improving quarter on quarter. I won't really talk about the specific numbers of Q4 as the results are kind of not yet out. So, but the fact is that as we kind of mentioned in all our guidances, is that every quarter has been looking good. Exactly the last year, every quarter was looking kind of bad. So in the last 2 quarters, it has been looking good. So if we continue to maintain it, we will at least have an exit run rate which is closer to the guidance, and we'll have to kind of improvise on it during FY27.
All right, and we look forward to that. With this, Mr. Baskar, we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you very much.
All right, but with this,